Multinational corporations rely on localized investment centers. Their function is straightforward. Take the capital provided on the balance sheets and deploy it to generate income. But as a parent company scales across borders and time zones, it hits a severe architectural constraint. Economists call it goal congruence. You hire smart, rational subsidiary managers and grant them autonomy. In return, they optimize their daily decisions precisely around the performance metrics you give them. And that is where the corporate architecture often fails. If you use standard, intuitive accounting metrics to measure success, you mathematically incentivize your local managers to actively destroy total corporate value. Getting a massive, decentralized organization to pull in one direction requires re-engineering the math behind localized self-interest. Let's look at how a single operational decision splits the reality between a local manager and corporate headquarters. The manager focuses entirely on their own profit and loss statement. If a move boosts their specific metric, they take it. The P&L math isolates them, leaving them blind to the parent company's broader economic reality, dropping on the right side of the screen. To fix this disconnect, headquarters has to dismantle three structural pillars of internal accounting: relative percentage metrics, static internal pricing, and purely financial lagging indicators. We have to move away from executing rote accounting formulas and start designing behavioral incentive systems. Notice Osaka's massive $636,000 income. We evaluate this using return on investment, dividing income by assets. Despite Osaka's huge income, its massive asset base drops its efficiency to a 6.4% ROI, falling mathematically behind smaller operations like Mumbai. This ratio creates a specific vulnerability. We can call it the high ROI manager's veto. Imagine the parent company's cost of capital is 2%, but a division manager is running a highly efficient operation with an 8% ROI. A new expansion project crosses their desk, guaranteeing a 6% return. That easily covers the parent company's cost, adding cash to the firm. The manager will reject it. Taking a 6% return dilutes their 8% average, shrinking their personal scorecard. Percentage-based metrics are structurally flawed. They incentivize high-performing managers to shrink their operations to protect a ratio rather than grow absolute corporate wealth. To restore behavioral alignment, we need a different accounting mechanism. That mechanism is residual income. Residual income drops the percentage format, measuring absolute dollars remaining after subtracting an opportunity cost of capital. This cost is the division's assets multiplied by the parent company's required rate of return, forcing the manager to internalize headquarters' hurdle rate before reporting a profit. Apply these new rules to that identical 6% expansion project from earlier. The manager knows the parent company requires a 2% return on those assets. The project pays 6%. That leaves a positive spread of 4%. Under residual income, that spread translates into actual, absolute dollars added directly to the manager's performance measure. They enthusiastically accept the project. Substituting an absolute dollar metric for a percentage ratio ensures that whenever the corporation gets richer, the local manager looks better. External investments are only half the architecture. The alignment problem multiplies when autonomous divisions within the same parent company buy and sell from each other. This introduces transfer pricing. The internal price set for these goods dictates the revenues for the selling division and the material costs for the buying division. It defines the perceived profitability of both sides of the trade. One common method is full absorption cost, calculating materials, labor, and overhead to arrive at a transfer price of $13.50. This guarantees the seller avoids a loss, but destroys their incentive to control overhead, passing inefficiencies to the buying division. You could use the external market price instead, $40 a unit. While this simulates external realities, charging full market price internally is mathematically justified only if the selling division is operating at maximum capacity and actively turning away outside customers. Rigid internal pricing policies create localized monopolies. They distort true divisional performance data by forcing one manager to subsidize another. The critical variable that breaks standard transfer pricing is physical production capacity. It fluctuates constantly, and the internal math has to react to it. Consider a scenario where Division A has significant idle capacity on its floor. They still demand their standard internal market price of $10 per part. Division B acts rationally, finding an external supplier offering the exact same part for $9.50. They buy from the outsider, saving 50 cents on their P&L. But zoom out to the corporate level. Division A's true variable cost on that idle machine was only $4. By paying an outsider $9.50, the parent company bled $5.50 of corporate value. To prevent this, transfer pricing must shift to a negotiated rate closer to the variable cost whenever excess capacity exists. Division A stays busy covering its fixed costs, and Division B gets a discount. Internal markets cannot be rigid. Goal congruence demands dynamic pricing rules that track the physical constraints of the production floor. Residual income and dynamic transfer pricing solve the accounting math, but they're strictly lagging indicators reporting on financial outcomes that have already happened. To truly align behavior, corporate headquarters needs a framework that bridges those lagging financial results with leading operational indicators. We use a balanced scorecard. This strategy map shows top-down architecture. Financial outcomes are supported by causal arrows flowing up from customer, internal processes, and learning. Managers must tie non-financial metrics, like defect rates, directly to residual income. A dollar invested in training flows upward, lowering cycle times and driving EBIT. Auditing financial outcomes only reveals the results of past choices. It cannot explain the operational friction that eventually manifests as lower margins. Headquarters must actively manage the underlying human and systemic drivers, the training and cycle times, that determine whether financial targets are achievable in the first place. True goal congruence is an engineering challenge. It requires a system that integrates absolute economic realities, dynamic internal markets, and holistic operational frameworks into a single, unified corporate direction.